Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the upcoming FOMC meeting on Wednesday, February 1st, and the implications of various outcomes, and also try to digest some of the data that the Federal Reserve is likely processing to help make their decision more informed. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. We do have several different tiers available, including a free one. Make sure you check it out. Links in the description below. Let's go ahead and jump in. So, of course, it's that time where everyone starts speculating, dubiously, of course, on what the next Fed funds increase is going to be. Will it be 0? Will it be 25 basis points? Will it be 50 basis points? And, of course, you have some people even calling for 75 basis points. History shows us for quite a while now, in fact, that the consensus view has actually been pretty accurate. So going against the consensus view on what the Fed funds rate is going to be has actually not served people well anytime recently. Now, when we think about what is the Fed likely going to go, where are they going to go with their next interest rate hike, the CME group is saying about a 99.8% chance of a 25 basis point rate hike. And the sort of the extra probability that you get keeps going between 0 and 70 and 50. So I think it's safe to say that, of course, the most likely outcome by far is a 25 basis point rate hike. Now, in this video, we're also going to talk a little bit about the careful balancing act that the Federal Reserve is currently trying to pull off right now, because it's actually fairly complicated when you get into the nitty-gritty details of exactly what they're trying to do. So 25 basis points. Now, the bulls might prefer for the Fed to stop. The bears might prefer for the Fed to go with 50 or 75. I do think it's important to try to have an unbiased opinion rather than stick to any specific narrative. Let's try to understand why the Fed would go with 25 as opposed to 0 or 50. Okay? So before we get too far into this, one thing to note very briefly here is that the 2-year Treasury yield has a pretty good track record of identifying within a pretty close tolerance the terminal rate. And recently, in fact, if you zoom in over here, you'll see that the blue line right here is the Fed funds rate, and the 2-year Treasury has actually come down below that now. Now, normally when that happens, if you look at the context of history, when the 2-year Treasury goes below the Fed funds rate, it typically means that the terminal rate is not too far away. So it is probably safe to say that at least within the short term, the Fed will be stopping their interest rate hikes relatively soon. If you're curious about exactly when that might be, the markets are currently saying 25 basis points in February, 25 basis points in March, and then a pause in May. And then they're not projecting out rate cuts until all the way out potentially sometime in November or December of 2023. Now, if the market is not thinking there's going to be rate cuts until the end of the year, then that means one of two things. That either means they think there's not going to be a recession this year, because if there is a major recession, then the Fed would likely cut, or it could mean that they think there is a recession, but the Federal Reserve isn't going to care much about it because their mandates are going to be to bring inflation back down and to make sure that we have a fairly good labor market. So one of the things I want to talk about a little bit is really diving into the chart on both headline inflation and core inflation. Okay, so and there is a left tail risk that we must consider. I'm not saying it's the most likely outcome, but it's something that we at least need to consider, especially with the likes of China reopening and the recent surge in some commodities in terms of their pricing. If you look at headline inflation year over year, you'll note that we have a fairly nice peak over here back in June at approximately 9.1%. Now, since then, it's actually been coming down in a somewhat monotonic way. It hasn't really gone back up. It just continues to slowly go down. If you've watched some of my recent videos, we've talked a lot about looking at the derivative of this stuff. A lot of times, it's not the direction that a metric is heading, but it's actually sort of the rate of change. Is it getting worse? Is it getting better? For instance, housing prices have come down, some over the last year, but it's actually decelerating in terms of how much they're coming down, and activity is starting to pick back up again. If you also look at the automobile industry and you look at used cars, we know that last year they came down quite a bit, and a lot of people were sort of spooked away from that market. But if you look at anecdotes around the internet, a lot of car companies are talking about fairly robust Januaries where they're making a decent number of sales, which is going against what their expectations were. Okay, so again, there remains, of course, a left tail risk to the market, and that is, well, what if inflation does not continue to come down like this? Do we have any reason to think that it wouldn't come down in a fairly linear manner? What would cause it to be stochastic, right? Well, if you actually look at the monthly change on this, so we're going to take a look at the monthly change, and all we're going to do here is we're going to zoom in to the last the last couple of years or so. What you may notice is the rate of change was actually picking up here for a while, but it's starting to flatten out a bit. Okay, it's starting to flatten out a bit. Now, if it were to stay at this level, negative 0.65, negative 0.7, something like that, then this is going to continue to come down fairly quickly, right? You can see that it's moving down in a somewhat linear manner right now because the percent change is remaining the same. But again, go back to the monthly change. The left tail risk, of course, is what if this starts to curl back up over the coming months? So that is the risk, I think, to inflation, is that with looser monetary conditions today than we had at the end of last year, it's sort of leading back to a surge in demand in different sectors. And will that impact inflation sometime later this year? If it does impact inflation later this year and causes it to remain somewhat stickier than people are thinking, then you could see another surge in treasury yields, and you could see those move back up to the upside, and you could see the Fed funds rate continue to move up as well. But as of now, we have not seen that. It's a left tail risk that exists. We need to be aware of it, but it's simply something that the Fed, of course, must consider. So that would sort of be the case to make that a 25 basis point rate hike still makes sense, because you don't want to loosen too quickly. If you do, you run the risk of experiencing something like what we had back in the 1970s, where they loosen and then they tighten and then they loosen and they tighten, and they just keep doing it, and inflation just refuses to go away, and you continue to see incrementally higher peaks. This is something that Powell has said many times he does not want to get into, right? He does not want to go this route where inflation remains entrenched. So for that reason, it would make sense to at least have a rate hike, right? Even only a 25 basis point rate hike, it would at least show that they're sticking to their resolve in making sure that they get the job done before easing in any fashion. Now, you might say, well, is this not a risk, right? Is it not a risk that why not go 50 basis points if this is potentially starting to curl up? Well, first of all, it's not curling up yet, but there's also this idea of the U.S. economy and what is the damage going to be done to the U.S. economy by all of the interest rate hikes last year, okay? Now, one of the things that I've mentioned before is this smooth recession, U.S. smooth recession probability indicator. And one of the things you'll notice is as of November, the likelihood that we're in a recession is only 1%. And this is one of those things where, you're going to have a lot of people that are going to say we're in a recession because we had 2 consecutive quarters of negative GDP and and things of that nature. But again, real GDP has actually picked back up recently. Now, if you actually dissect the data, it is starting to weaken some. And so there's a fine line that the Federal Reserve is sort of walking here between raising interest rates to a sufficiently restrictive level to bring inflation back down, but also not wanting to send us into a deep recession. If you look at the indicator that we just talked about, so the smooth recession probability indicator, it's made up of four things, right? It's made up of non-farm payroll employment, which we're going to be getting more data on Friday, the index of industrial production, real person excluding transfer payments, and real manufacturing and trade sales. And so it's worthwhile to at least see what's going on with those four indicators. If you look at total non-farm employees, and you look where it is right now, so we're looking at the monthly change, it's slowly trending down, but it's still well above zero. And the reason why zero is important, because you can see when it goes below zero in a sustained fashion, that typically corresponds to a recession. So, there's still a little wiggle room here, right? But I imagine that the Federal Reserve does not want to just send us into a very deep recession that's going to be hard to dig ourselves out of. So again, there's also that risk of over-tightening. Now, Powell has said many times that he would rather over-tighten and then roll it back later on rather than risk not tightening far enough. Okay, so I think there's like a balancing act here between, you don't really want to do 0 basis points because that might give the impression that it could actually give the impression that they think the economy is getting really weak, and that might have a different effect on investors. But I think a 25 basis point rate hike sort of says, hey, we're going to keep at it until the job's done, but we don't want to get too far gone and risk sending us into a recession that is going to last quite a long period of time. And so I think it's a balancing act, and that's why I think, and I agree with the consensus view here, that they're likely going to go with 25 basis points. And if you look at some of the other indicators that make up the smooth recession probability indicator, of course we have non-farm payroll, total non-farm employees has been trending down. Still plenty of wiggle room in terms of getting into recession territory based on that indicator. But you have other things like the producer price index, which, if you look at the monthly change on it, it was coming back up, now starting to go back down again. Now, why is this important? Well, if we apply a moving average here, and I'm just applying the moving average to sort of get out some of the noise and try to identify where it actually turns into a recession, you can see that if we spend a sustained period of time at these levels, oftentimes, but not every time, it does end up corresponding to a recession. So again, we're not saying we're in a recession right now, but there are some indicators that are giving some warning signs, and I'm sure the Federal Reserve is fully aware of this. If you look at the total industrial production index, it's also not heading in the right direction. So this is a 3-month moving average of the monthly change. It's heading down. And when you look at prior periods where it was starting to go down like this, it did end up corresponding to a recession. Now, are there plenty of times where it didn't? Yes. Look at all these times where it went below zero, but it did not it did not actually correspond to a recession. So it's all about how far gone is the economy from all the interest rate hikes last year. So far, again, just going off by anecdotes that I've seen online, based on the real estate market, based on the car market and things of that nature, it does seem like activity has actually picked up recently despite the higher interest rates. So it does seem to some degree that the economy is more resilient than a lot of people might have imagined it would have been, and people are actually starting to quickly adjust to higher interest rates. But the question, of course, is, well, the long-term effects of interest rate hikes can take a year to fully be felt. So what is that going to be like, in the second half of this year when all the interest rate hikes from 2022 are starting to be felt? So that's sort of the big question that we have to ask ourselves. And of course, there's going to be a lot of lag time on these indicators and sort of where they're actually going to all correspond to either saying we're heading into a recession or saying that we're going to avoid one. And then you have real and personal income excluding transfer receipts, which is actually moving in a positive direction recently. If you look at the monthly change, it's actually been going up. So again, when you look at, and then there's one more, the real manufacturing and trade industrial sales, this is also part of that indicator. It's actually been heading down recently if you look at a 3-month SMA of the monthly change. If you just simply look at a not a simple moving average, you can see it's also been decreasing recently. Of course, it's not going in the right direction, okay? Because when it gets too far negative in a sustained way, it's typically not a good thing for the economy. So then, what is the risk, right? What is the risk that the Federal Reserve is weighing here? You have, on one hand, you can see that inflation is coming back down, right? You can see that inflation's coming back down in a material way, okay? Annualized, when you look at some of the most recent readings, they actually are starting to look somewhat optimistic, okay? So you have inflation coming back down, both core inflation, headline inflation, PCE, There are some parts of it, though, that the Fed cares about, that Powell's talked about, that are remaining somewhat sticky. And so, again, that's why it's a balancing act. I'm sure they can see the indicators, or at least they're fully aware of things like the PPI and these other indicators that are suggesting that the economy is starting to look somewhat weak, right? I'm sure that they are fully aware of that. So the ultimate question, of course, is, can they bring inflation down without sending us into a full-fledged recession, right? That's the ultimate question I think a lot of people are asking. And of course, there's the soft landing camp that are saying that that everything looks good, inflation's coming back down, and the Fed will reach their terminal rate, and then they'll tighten later on, and the economy it'll be almost like it never even happened, right? We managed to avoid the recession. You have the hard landing crowd, which says, well, if you look in the context of history, especially coming out of a period of high inflation, a soft landing is something that's not typically achieved. Again, look at prior periods where you had really high inflation levels. And actually, let me go back to the inflation chart. If you look at periods where you had high inflation levels, you don't typically see a soft landing. I'm not saying it can't happen. It's just something that it's not often achieved. It doesn't mean it can't be achieved. There are circumstances this time, for instance, injecting trillions of dollars into the economy in a short period of time, that I'm sure are going to have some effects that were not necessarily the same back in the 1970s. So, of course, this is something that we need to keep in mind. But you have some indicators that are starting to show weakness in the economy. You have some, on the other hand, that have remained incredibly resilient. One of the things I've said recently is that if you want to look for signs of a recession, look everywhere but the unemployment rate, right? Because you can find the signs in almost every other macro indicator, or at least you can see the weakening in various areas. But if you look in the one thing that the Fed really cares about, the unemployment rate, you're simply not going to find it, at least not yet. Now, we know the business cycle. In the business cycle, the unemployment rate is one of the last things to finally move. So it's not to say that it won't go up. It's just to say that it's a lagging indicator. And by the time it starts going up in a material way, the Federal Reserve will then likely start to cut. They might not cut if it just goes to 4% or something, but if it goes to like 6%, then I imagine they would start to cut. But the problem is, and this is what history shows us, is that even if they start to cut at that point, the economy is usually too far gone, and that's when we enter into a deep recession that can take quite a long time to get out of. So we talked about the left tail risk early on, and that is, well, what if inflation comes back up? There is a potential scenario here where we should at least mention the S&P, where the S&P is actually broken out of this trend line. Now, is it repeating what happened in 2001, where it just sort of puts in a triple top? I don't really know. To be completely honest, I don't know. In all my time of looking at charts, when you look at past things and try to project them onto the future, typically doesn't work out that well. Not saying it can't happen, but usually the charts play out in a completely different way, and that's not so predictable. So I do remain somewhat skeptical to just use a prior cycle, a prior business cycle, and say, well, it has to play out the exact same way. So there is a potential outcome here that we should consider, and that is, as long as inflation's coming down, by the way, core inflation, you look at the monthly change, it's been moving down in a material way. Recently, it started to move back up a little bit. But as long as inflation's coming down and the indicators are not screaming that we're in a recession, right? Even if you look at, say the more technical indicator that some people were talking about last year, and that was 2 consecutive quarters of negative GDP, even when you look at that, it's not really screaming that we're in a recession just yet. And so as long as you have inflation coming down and the U.S. economy is still holding up, then we're sort of in this intermediate range right now, or these certain, special market conditions where the objective of bringing inflation down is going as the Fed wants it to, and the U.S. economy is not yet falling apart. And so risk assets like equities, like cryptocurrencies, right, like including Bitcoin, are continuing to show resilience, and the prices have been continuing to move higher. So what you'll notice is that a lot of these risk assets continue to sort of climb this wall of worry, where it kind of seems like a recession is coming at some point in the nebulous future. But as long as it's not here now, markets continue to shrug it off, right? So then the thing to look for, and I've said this before, is what does the Fed do tomorrow? My guess, honestly, is just to go with consensus view, say 25 basis points. I mean, if they go with a different number, I'm sure I'll make a video tomorrow and we'll talk about the implications of that. But assume 25 basis points, and I would expect him to try to talk the market down. I'm not saying he's going to have any success at it, but I imagine he'll try to talk the market down. One of the reasons I imagine that he will try to talk the market down, whether he has success at it or not is another story, is because of the wealth effect, right? Is if the market pushes a lot higher, then you're going to have the wealth effect start to take over again. And if people start to feel wealthy because their portfolios are higher, they're more likely to go spend money. And if they're more likely to go spend money, that's, of course, going to increase demand, and it's going to lead to higher prices more than likely. And that could, of course, continue to make the Fed's mandates more difficult to achieve, because then they're sort of continuing to have to deal with potentially inflation becoming entrenched. Now, one of the things that they've talked about a lot is wage inflation. And we actually got a recent report out today, the ECI, and it actually is looking like wage inflation is starting to, or at least the risk of it is starting to subside a little bit. So I imagine that the Federal Reserve will like to see that. So again, my speculation is that 25 basis points is what we'll likely see. Powell will try to come out and talk the markets down, and we'll see if he has any success at it. We have talked a little bit about this sort of less left tail risk of what happens if inflation has a surge back later on this year. What would that look like? Well, I think the risk there is you do have China reopening, and of course that could lead to a surge in demand. Although, to play devil's advocate on that, I also think China closing was also used to talk about why inflation was going to go up. So now it's talking about it opening and using the same reason to say that it's going to go up. It kind of just shows you that, we can always find a narrative for anything if we try hard enough, right? Because if China's closing, it means inflation's going up because supply chains are breaking down. If China's opening, it means inflation's going to go up because the demand is going to come back. So, of course, there's going to be a narrative for everything. But there's a risk, right? There's a risk with demand coming out of China that it could lead to higher prices. And so we have to think about that. But one of the other things to look at are some of the commodities. So if you look at copper, take a look at copper recently. And the reason why I like this one is it actually leads CPI fairly robustly, at least for quite a while. So the candles are copper, and then the blue line here, so if you look at the blue line right here, that's U.S. inflation year over year, so headline inflation. And what you'll notice is that, copper bottomed here in December 2008, and then inflation bottomed in July 2009, so it's about half a year lag. But then copper peaked in March 2011, but then inflation didn't peak until about half a year later. So there does seem to be some type of a lag with the direction of copper and inflation. Now, of course, it's not as simplistic as that. I'm sure it's a lot more complex, but it is an interesting indicator. Again, over here, you can see that copper was going up. It hit its peak, and then inflation hit its peak, about half a year later, right? So copper hit its peak in December 2017, and then inflation hit its peak about half a year later in June of 2018. The lag has not always been half a year, and the last three examples were. Here's an example where copper bottomed in March of 2020, and then headline inflation bottomed in May of 2020, so it was only a 2-month lag. And then if you go look recently, you can see that copper peaked in March of 2022, and then headline inflation peaked in June of 2022, so about a 3-month lag. Now, the risk is copper's going back up, right? So you can see right now, copper's going back up. If you don't cherry pick this wick, right, it would be very easy to cherry pick this wick and say, well, technically it bottomed back in July of 2022. If we don't cherry pick the wick and just say, it actually bottomed sometime in, September or October, then we're getting out to the half year mark in say like March. So does that mean that inflation is going to be stickier than we could have imagined? So what happens if the Fed does 25 basis points and then 25 basis points again, and then pauses, and then if we have looser monetary conditions, inflation starts to go back up again? That's something that's not potentially being priced by risk assets. Now, of course, the caveat to all that is, well, until it actually starts to go back up in a material way, risk assets might just continue to shrug it off. So again, we're existing in this phase where inflation's coming down, and it doesn't yet seem like we're in a recession. And going back to the whole recession idea, and this is something we talked about for a while now, and I've I've been trying to be fairly careful on how I say things, because the thing is while there's a lot of indicators that suggest a recession is coming, there's also a lot of indicators that say, yeah, like it's coming, but it's not here yet, is the thing, right? I mean, look at the treasury yield spreads. When you're inverted like this, when you see that deep inversion, you don't typically go into a recession during that deep inversion, right? No, it comes later, after the Fed pivots. And right, that's when a lot of risk assets lose a lot of their value, is after the Fed pivots, because it takes them breaking something for them to normally pivot. So again, this is something that we have to think about. And I mean, it's not just copper. If you look at you can look at other sectors as well. I mean, take a look at lumber. We'll take a look at monthly candles on lumber. I mean, look at this. Lumber's up like over 30, almost 40% this month, like 36% on at least this one, right? 36% in a month. It's back to where it was, back on the monthly close of July of 2022. And I'm sort of saying this in a joking way, but like, look at the price of eggs, right? I mean, like, of course, eggs is not going to have the same type of effect that other things might have, but it's one of those things that just kind of shows, like, inflation is still a risk, and the Fed knows this, right? The Fed knows that inflation is a risk, and even though it's heading down right now, doesn't mean it's going to always head down. And with China reopening, with looser monetary conditions in play right now, of course, you can talk about the debt ceiling and that sort of stuff, and the injection of liquidity there, sort of offsetting the quantitative tightening that the Federal Reserve is doing. It's leading to the rise in risk assets. The wealth effect is potentially taking hold again. You're seeing people go buy cars more so than they were in December. You're seeing people get back into the real estate market more so than they've been expected to. And so that's the risk, right? What does the Fed do? Do they go 0 and say inflation is subsiding? Probably not. Do they go 50 and say, hey, and yes, inflation's coming back down, but the market can handle it? Probably not either, because again, there are a few indicators that are suggesting the market is starting to show some signs of weakness. So one of the things that I'm sure some people who might be listening to this video are thinking is like, well, can't you just say either we're going to get a recession or we're not? Or look, the problem is macro conditions are very hard to predict. I'm just trying to show you what are the risks involved. There's the left tail risk of inflation coming back if they loosen too soon, but there's also the right tail, which would be positive for risk assets, and that's the idea of a soft landing, the ability for the Federal Reserve to raise interest rates to get inflation back down, but not to hurt the U.S. economy in a way that sends it into a deep recession. And let me tell you, it's a very polarizing view right now. And there's a lot of different macroeconomists that I've followed for a long time, and I've never seen more polarizing views than I have over the last 3 months. Okay, I mean, like I've never seen more polarizing views, and it's because it's easy to find the data to support the narrative. If you're a bull, it's easy to find data to support the narrative. You point to the fact that markets have been rallying since October. October historically is a time that markets can bottom. You might point to the fact that normally during the year after midterms and before presidential election year is normally a positive year for risk assets. You could point to the fact that inflation is coming down in a material way. You could point to the fact that the unemployment rate remains at secular lows. Again, you can find signs of a recession, just don't look in the place that matters, and that's the labor market, right? But if you're a bear, you could also find plenty of data. You could look at the producer price index and say, look, this is coming down quickly. You could look at inflation and say, yeah, it's come down a lot, but history shows us that inflation is not something that's going to give out without a longer fight. And if that's the case, you could see it surge back up if the Fed loosens policy too soon. And of course, the bears would also simply point towards all the bear market rallies that we've had so far that did not lead to any sustained new highs, and they could point to the fact that the interest rate hikes from last year have not been fully felt by the U.S. economy. So again, all sorts of things that you could point to. I'm not here to, I'm not here to tell you which one's necessarily right, but there's a risk both ways. And I think you need to think about both of those risks when you navigate these financial markets. And it's only when you actually consider the risks on both sides do I think you can actually navigate the markets in a fashion that is suitable to you. And remember that your risk tolerance is likely going to be different than someone else's. For instance, someone close to retirement might not want to take on the same risk as someone who's in their 20s who might not really care if we go into a recession because they have decades of time to make it all back. But again, if you're heading into retirement, you don't necessarily have that same luxury. So again, it's all about your own risk management. What do you think? What indicators do you put the most weight in? My opinion right now, just to be completely honest, is I think we're just sort of in this interesting intermediate phase where inflation's subsiding and the economy is weakening some, but it hasn't yet shown signs enough of sustained weakness for the markets to acknowledge it. We do get some more jobs data on Friday, so that'll be interesting to look at. We also have earnings reports for Meta, Apple, Google, and Amazon all this week. So that should provide some guidance going, at least in the next month or two. A lot of things to look forward to. I hope I haven't taken too much of your time and hopefully you've gotten something useful from this video. But I just want to remind people that it's an interesting balancing act. And even since I started the video, right? You can see the percentage is now still 99.6% and a 0.4% chance of a 50 basis point rate hike. So again, likely going to be 25. You're likely going to see Powell try to talk the markets down. If he's unsuccessful in doing so and monetary conditions loosen up too much over the next few months, you could see inflation come back. If on the other hand, Powell drops the hammer and comes out as hawkish as he was back at Jackson Hole, then we might just simply go back into sort of another leg down in risk assets. So it all really depends on what the Fed does, how hawkish or dovish do they want to be, and of course, the ongoing effects and the ongoing lags in the economic data. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up. Remember, we do have Into the Cryptoverse Premium at intothe.cryptoverse.com. Links in the description below. Again, we do have a free tier, so make sure you check that out. I'll see you guys next time. Bye.